Well, thank you again for taking the time to watch this video. This is number 8 in our series on real estate investment. And I want to talk to you today about the down payment. We outlined to you a very simple plan for amassing wealth and reaching a point where you can retire on passive income. And that simple plan was buy one property a year for 10 years, never amortize your mortgage for more than 15 years, and never sell. A very simple plan, but not necessarily an easy plan. And the most difficult part of the plan is coming up with a down payment. If you've purchased, and I'm sure most of you own your own home, if you purchased that home some time ago or very recently, doesn't matter. The most difficult part, you will recall, was getting the down payment. And it still is. And I'm asking you to do it not once, I'm asking you to do it 10 times. Now, we talked about conventional versus high ratio mortgages. And a high ratio mortgage is a mortgage that needs to be insured. And as a rule of thumb, anything on a residential property of less than 20% down requires high ratio financing, and it must be insured. When you're dealing with multifamily, duplex, triplexes, as opposed to single family, and you're dealing with investment property, CMHC won't come to the table to insure it unless you're going to be living in it yourself. You can buy a triplex, you can buy a duplex, and as long as you are going to be living in one of the units, no problem, they'll finance it. But if you're not, then that really isn't an option that's open to you. What options are open to you? Well, one of the things that sometimes you can do, depending on the property, is you may get seller-assisted financing. You see, you're not locked in like buying your own home where you're limited to the one home, the dream home. You're looking for an investment property, a property that you can rent out. So you keep your eyes open to a good opportunity, and financing is one of the components that you want to look at. If the current owner is an investor and he's starting to liquidate his investments, it may be he doesn't need the money to buy something else. He may be putting the money in a bank. And it's possible that you can encourage him to hold a mortgage because you would, even at conventional mortgage rates, you're going to be paying him a higher rate than what he'd get at the bank. And so it's a win-win. You have the seller hold a mortgage, and you can get into a high ratio level of a mortgage without paying insurance fees, and the homeowner, or at least the property owner, gets a better return on his investment. It may be, you won't probably be able to do this with conventional chartered banks, but you can with perhaps credit unions or alternative lending. It may be you want to go up to 80% conventional financing and get the vendor take back for another 10% and go in with 10% down. And again, the first one I bought, I was able to do that, and the seller held the mortgage rate the whole 15 years till it was all paid for. And so you can get the seller to hold or assist in the financing in some ways. Another thing, and I just want to share this as a possibility, it's something that served me well all the time I was acquiring investment properties, is I'll call it a forced tax savings. Nobody likes paying income tax, but it's a reality. And if you can go to your employer, if you're a salaried job, and you can increase the amount that's deducted from your pay by another 25%, 25% not of what you're deducting, 25% of your gross pay, then tax time is a wonderful time because you're going to get a chunk back. Now you have to tighten your belt. You're going to say, I'd never do it, but you could do it. And that money will accumulate, and the beauty of it is you can't get your hands on it partway through. The problem with savings in the bank, it's always tempting to spend some of it, and here you can't. So you put that extra money in, tax time, there's a chunk of money back, and that helps you acquire money for your down payment. The other reality is the chances are you're a homeowner. And as such, if you've owned your home for any time at all, property values have gone up, your mortgage has gone down, and you've got a fairly large piece of equity in your home. You can refinance your home and take equity out and use that as your down payment for your investment property. And the beauty of that is the increase in the mortgage is also tax deductible, the interest that you pay on it. So that's another possibility as far as home equity. And then finally, I want to leave you with the reality. I'm telling you to do this 10 times, but the first one is the toughest one. What's going to happen with your investment properties is they too are going to go up in value. In fact, we looked at the stats in Niagara, and we find in the last 5 years, property have gone up over 88%. So they're going to go up in value. At the same time, your mortgage is going to be depreciating the amount of principal you owe because you've amortized it over 15 years and a large part of the principal is being paid off. And so it won't be very long, 1 year, 2 years, 3 years, until you can refinance that property and take enough money out for that down payment on the next property. And so you can structure it in such a way that the first one is the toughest one and it gets easier and easier as time goes along. One of the things about the simple plan is that it requires 10 years to acquire the properties, 15 years to amortize them. It's 25 years. You say, well, I'm older. I'm not 30 any longer. I'm 55 or 60. The plan doesn't seem to work for me because I'm not going to be able to get the benefit till I'm 80, and that's just not feasible. There's some things that you can do if you're what I call the older investor to make it work. There's modifications to the plan, and I want to go over those modifications with you next issue. Stay with us. And by the way, if you're finding these valuable, take a minute to like them on Facebook and take a minute to share them. It'll help us get the message out, and we'd appreciate it so much. Thank you very much.